All right, let's dive right into this explainer. Today, we are breaking down Oceaneering International's Q1 2026 performance. Now, if you follow the offshore sector, you already know this business. But there is a massive strategic pivot underway right now that is completely changing the game. We're going to look past the short-term noise today to see if their big shift into the defense sector is actually creating a durable, long-term economic moat.
So, here's our agenda for today. We'll start with Oceaneering's Q1 2026 snapshot, then go by the numbers, compare energy versus defense growth, look at the competitive moat, analyze industry risks and headwinds, and finally wrap up with future outlook and guidance. Okay, Part 1. Oceaneering's Q1 2026 snapshot.
So this globally recognized brand, which, is famous for its offshore services, is in the middle of executing a truly massive strategic pivot. Basically, they are balancing out their cyclical core energy business with these highly predictable, long-term aerospace and defense contracts. It's a brilliant dual-use technology strategy. The goal here is to smooth out that earnings volatility and build a much more resilient balance sheet for the decades to come.
Now, looking at CEO Roderick Larson's recent comments, the absolute key takeaway here is the sheer scale of their commercial momentum. A $1 billion order intake? That represents one of their strongest quarters for new business since 2020. For us value investors looking at this, that is a massive injection of future revenue visibility and cash flow predictability. It essentially de-risks a significant chunk of their near-term operations.
Moving on to Section 2, by the numbers. We are definitely looking at a mixed reality here when it comes to the quarter's earnings quality. On one hand, top-line revenue actually beat expectations, growing 2.7% to $692.4 million. But if you look further down the income statement, net income dropped a pretty concerning 28%, down to $36.1 million, and adjusted EBITDA shrank by 13% to $83.7 million. So you're probably asking yourself, why is revenue growing while profitability shrinks? Well, we'll get to the structural reasons behind that in just a second.
But here's the thing. Despite those softer bottom-line earnings, management is still generating a highly efficient 35.9% return on equity. This metric is huge. It proves the underlying business requires relatively little capital to generate outsized returns. It's a classic Buffett-style hallmark of a highly capital-efficient operation. And honestly, this is exactly what's anchoring the stock price right around $38 and keeping long-term value investors engaged, even with a quarterly earnings miss.
All right, Section 3, Energy versus Defense Growth.
Here's where we see a crucial divergence in their business models. The traditional energy sector saw some heavy margin pressure. This was mostly due to lower vessel utilization, which dropped down to 61%, along with the geographic shift toward lower margin regions like the North Sea and Brazil. But take a look at the trajectory for aerospace and defense, or AdTech. Revenue here absolutely skyrocketed by 35% to $131 million, largely fueled by the incredible consistency of government funding. This segment alone added $175 million in new awards, beautifully offsetting that cyclical drag from the energy side.
What they are doing here is really smart. Oceaneering is actively taking its deep-sea, harsh environment expertise and applying it to the highly specialized demands of space and national security. By delivering the submarine rescue system for the U.S. Navy and supporting NASA's Artemis program, they are proving they possess unique, highly specialized engineering capabilities that are, frankly, incredibly difficult for competitors to replicate. So this isn't just about diversification, right? It's about leveraging their existing intellectual property to capture highly reliable, long-duration government cash flows.
Let's move into Section 4, the competitive moat.
Before we evaluate their competitive advantages, it is absolutely vital to understand the ROV, or remotely operated vehicle. This underwater robot is literally the technological workhorse of Oceaneering's entire offshore operation. They are essential for subsea inspection, construction, and intervention. These machines are the absolute foundation of their cash flow, and successfully operating them in such harsh environments requires just an immense amount of technical expertise.
Now, this list right here outlines a textbook-wide economic moat. Their sheer scale, boasting over 250 world-class ROVs, grants them a dominant 58% market share on contracted floating rigs. When you combine that massive scale with deeply embedded operator relationships, you get incredibly high switching costs. Add in the vertical integration of their in-house umbilicals and tooling, and you're looking at a business that is notoriously hard to displace. and that dual-use nature of their technology, it further deepens the moat by spreading research and development costs across both the commercial and military sectors. Okay, Section 5. Industry risks and headwinds. Looking at the immediate hurdles, geopolitical volatility in the Middle East has temporarily paused activity in their integrity management and digital solutions segment. Meanwhile, a one-time $5.5 million net accrual for a defense contract dispute kind of dragged down the ad tech quarter. But from a value investment perspective, management views these as temporary one-off issues rather than some sort of structural decline in the underlying business. Essentially, they're speed bumps, not roadblocks.
However, the structural threats to their margins are definitely more concerning over the long haul. They're up against mega-project rivals like Technip FMC, Subsea 7, and Saipem. These guys bundle massive services and vessel fleets together, which puts pressure on standalone hardware pricing. Furthermore, you've got these agile startups pushing fully autonomous uncrewed surface vessels, and they could severely threaten Oceaneering's traditional ROV day rates over the next decade. These are exactly the kinds of secular shifts a prudent investor must monitor to make sure that competitive moat isn't slowly evaporating.
Finally, Section 6, Future Outlook and Guidance.
Even with a soft Q1, management is firmly reaffirming their full-year guidance. They are projecting EBITDA to land somewhere between $390 million and $440 million. They expect this strong cash flow generation to resume with sequential growth kicking in right away in the second quarter. Maintaining this guidance really implies they have strong visibility into their operating environment for the rest of the year.
So, where does this confidence come from? Well, it relies heavily on a back-half energy market acceleration, along with a seasonal uptick in vessel utilization during the second and third quarters. They are also highly focused on rebuilding that manufactured products backlog. But honestly, most importantly, realizing this intrinsic value relies on management's ability to simply execute on that massive $1 billion backlog they've already secured. At the end of the day, execution is the ultimate driver of future free cash flow.
So, I'll leave you with this to consider. As Oceaneering transforms from a cyclical offshore driller into a diversified, dual-use technology powerhouse, is this the perfect time to look past the quarter-to-quarter noise? A $1 billion backlog certainly suggests a widening moat, but margin execution will ultimately determine if the stock offers a true margin of safety today. Thank you so much for joining me for this explainer, and keep exploring the data.